Gold is currently trading at $4,027.38, testing a major support level while central banks just added a record 289 tons of bullion. If you had $25,000 back in 1974, would you have been better off buying a median-priced American home or putting every cent into physical gold? Most people look at the skyrocketing prices of houses and assume real estate is the clear winner. But the truth about inflation protection is much more complex when you look at the last 50 years. We are going to strip away the surface-level gains and look at the hidden costs that most investors ignore. So which one actually preserved more wealth through the decades? The answer starts with a challenge that changes how you look at every dollar you own. When we look back at the 1970s, a $25,000 investment seemed like a fortune. Today, that same house might be worth hundreds of thousands, and gold has climbed from double digits to over $4,000 an ounce. It is easy to feel like you have made a massive profit just by looking at the sticker price, but this is often a dangerous illusion. If your asset goes up 10 times in price, but the cost of bread and fuel also goes up 10 times, you have not actually gained any wealth. You have simply stood still while the currency around you melted away. This is called the sticker price illusion, and it is the first mistake that keeps investors from seeing the true value of their holdings. To understand the truth, we have to look at purchasing power parity. This is a fancy way of asking how much stuff your investment can actually buy at the store. 50 years ago, an ounce of gold could buy a specific amount of goods. If those same assets cannot buy the same amount of goods today, your wealth has been eroded by the silent thief of inflation. Establishing a baseline for this 50-year journey is the only way to see who is actually winning the race for financial security. But there is a much bigger problem with real estate that most people do not realize until they get the bill. Before we keep going, if you're serious about protecting your savings with real assets, grab your free Gold IRA guide linked below. It explains exactly how to diversify part of your retirement into physical gold safely with no setup fees for up to 10 years. You'll find the link right below this video. Just click it, request your free guide, and see why so many investors are moving away from paper wealth and back to something real, gold. Now let's keep going. Real estate is often called a passive investment, but anyone who has owned a home for decades knows that is rarely the case. There is a quiet drain on your wealth that gold investors never have to deal with, and it starts with the 1% rule. Financial experts generally agree that you should set aside 1% of your home value every single year just for basic maintenance. Over 50 years, that means you might end up spending more on the upkeep of the house than you originally paid for the entire property. A roof only lasts 20 years, and an air conditioner might only last 15. These are not optional costs if you want the house to keep its value, but they act as a permanent weight on your total returns. Then there is the issue of property tax, which many investors call the infinite rent. Even if you own your home outright with no mortgage, you must pay the government every year just for the right to stay on your land. These taxes tend to go up over time, and they never stop even after you retire. When you add in the cost of insurance to protect against fire or storms, the recurring expenses of real estate become a massive hurdle. Gold does not require a new roof or a coat of paint, but that is only the beginning of the maintenance gap. Gold offers a unique contrast to the physical decay of residential property because it is chemically inert. This means it does not rust, it does not rot, and it never needs a modern kitchen to keep its value. While a house requires constant renovation just to stay competitive in the local market, a gold bar remains exactly the same for centuries. When you hold physical metal, your financial strategy is essentially to do nothing, which can be a massive advantage over the long term. You do not have to worry about a tenant damaging the floors or a pipe bursting in the middle of the night. This lack of physical decay means that your investment is not fighting against the laws of nature. The storage costs for gold are also much lower than the upkeep for a home. Whether you use a professional vault or a high-quality home safe, the annual fee is usually a tiny fraction of what you would spend on a single plumbing repair. This makes gold a zero-maintenance alternative that frees up both your money and your time. Time is a hidden cost that many real estate investors forget to calculate. Managing a property requires constant attention and emotional energy that could be spent elsewhere. But there is one specific reason why real estate often looks like it is winning the race despite all these costs. Now, real quick, make sure to subscribe for more gold videos and hit that notification bell so you never miss a new video. Now, let's keep going. While gold is a simple asset, real estate has a secret weapon that can make people incredibly wealthy very quickly. This is known as the leverage multiplier, or the ability to use other people's money to buy an asset. When you take out a mortgage, you might only put down a small portion of the price, but you get all of the appreciation. If the home value goes up by 10%, you have actually made a much higher return on your initial cash because the bank provided the rest of the funds. This power to magnify gains is why many people prefer property over the steady growth of precious metals. However, this strategy comes with a very dangerous catch that can wipe you out. The interest rate trap is a real threat to anyone using debt to build wealth. If the cost of borrowing money is higher than the actual growth of the property value, you are losing money every month without realizing it. In a high-interest environment, your mortgage payments can eat up all the potential profits you hope to make. Gold represents the opposite of this risky strategy because it is an unleveraged asset. You own it outright with no debt and no counterparty risk. This purity provides a level of safety that a mortgaged home can never match, especially when the market starts to turn. In a perfect world, you have all the time you need to manage your investments, but financial crises often happen when we least expect them. This is where the speed of exit becomes the most important factor in your survival. If you need a large amount of cash tomorrow, selling a house is almost impossible because of the long closing process. You have to deal with inspections, appraisals, and waiting for a bank to approve a buyer's loan, which makes real estate a trapped asset during urgent times. Even in a fast market, it can take months to get your money out of a property. Gold is the exact opposite because it is recognized and traded globally every single day. You can take a gold coin to almost any city in the world and turn it into the local currency in a matter of minutes. This global portability is a massive advantage for anyone who values liquidity. If you need to move your wealth across a border or just pay for an emergency, gold is ready when you are. Another problem with real estate is that you cannot easily sell just one room of your house to pay a bill. You either own the whole house or you sell the whole house. Gold is easily divisible, allowing you to sell exactly what you need while keeping the rest of your hoard intact. Both gold and real estate are famous for being hedges against inflation, but they react to a failing currency in very different ways. Gold typically has an inverse relationship with the local currency, meaning its price tends to surge when people lose confidence in the central bank. It is a direct bet against the printing press. Real estate takes a different approach by allowing owners to raise rents as the cost of living goes up. This income can help you keep pace with inflation, but it only works if your tenants can afford to pay more. If wages do not go up as fast as inflation, you might find yourself with an empty property that no one can afford. There is also a regional ceiling on how high property values can go. A house is only worth what the local workers can afford to pay for it, which ties your wealth to the local economy. Gold has no such limit because it is priced on a global market that is not dependent on any single city or state. This global pricing means that if your local economy collapses, your gold can still protect you. But before we decide which asset is better, we have to look at the one thing a house provides that gold never will. We cannot ignore the fact that real estate provides a basic human need that a gold bar simply cannot fulfill. A house gives you shelter, which is a form of dividend that economists call imputed rent. This means that every month you live in a home you own, you are essentially paying yourself the money you would have otherwise handed to a landlord. This hidden return adds up to a massive amount of value over 50 years and is a strong argument for why property belongs in a portfolio. You are getting a utility out of your investment every single day. Gold, on the other hand, is often criticized because it just sits there and does not produce a monthly check. While it is true that gold is a non-productive asset, its purpose is not to create income, but to protect the value you have already earned. It is a silent guardian of your wealth that does not require your attention. Many investors find that the peace of mind they get from a physical reserve is just as valuable as a roof over their head. The psychological security of owning a portable, high-value asset is a major factor in long-term investing. However, the government has a very different view of these two assets when it comes to taxes. When it is time to take your profits, the government will be waiting to take their share, and they treat these two assets very differently. Real estate investors often have access to powerful tools like the 1031 exchange. This allows them to swap one property for another while deferring their capital gains taxes forever. This can lead to massive wealth accumulation over a lifetime as your capital continues to compound without being cut down by the taxman. Gold holders generally do not have this luxury. In many jurisdictions, gold is taxed at a higher collectible rate, which can take a significant bite out of your final net profit. There is also the historical risk of government intervention to consider. In the past, some governments have attempted to seize gold from their citizens during times of crisis. While this is rare, it is a risk that gold investors must keep in mind when they choose where to store their metal. Real estate is much harder to seize in the same way, but it is much easier for the government to tax. Because a house cannot be hidden, it is a very visible target for new levies and fees. This brings us to the question of who is actually buying these assets on a massive scale right now. If you want to know which asset is the ultimate safety net, you should look at what the largest financial institutions in the world are doing. Central banks around the globe have been hoarding gold at a record pace, recently adding hundreds of tons to their reserves. This is because international regulations have reclassified gold as a risk-free asset. This means it is now considered just as safe as cash or government bonds in the eyes of the global banking system. You will notice that these same banks are not buying up residential neighborhoods to back their currencies. They prefer the standardization and purity of gold bars because they are easy to trade and value. Gold functions as the ultimate collateral and the lender of last resort. When all other financial systems fail or a currency becomes worthless, gold is the only thing that can settle international debts. This institutional support gives gold a level of stability that a local real estate market can never achieve. But even with this high-level backing, there are still major risks to consider. The physical nature of your wealth becomes critically important when the world starts to change in ways we cannot predict. The physical nature of your wealth becomes critically important when borders change or local economies collapse. Real estate has a major weakness in these scenarios because it is an anchored asset that is forever tied to a single location. If the local government raises taxes to extreme levels, you cannot simply pick up your house and move. This is known as the anchor problem, and it can turn a great investment into a liability overnight if the neighborhood falls into decay. Gold, on the other hand, represents wealth in a suitcase. It is the strategic advantage of being able to transport high value across borders in a compact and universally recognized form. When a worst-case scenario, gold is the only financial asset that is not someone else's liability. When you own a house, you are dependent on a functioning legal system to prove that you own the land. If the legal system fails or the government changes the rules, your property rights could vanish. Gold does not require a contract or a court to have value. It is valuable because of what it is, not because of a promise made by a third party. This sovereign immunity is why people have used it for thousands of years. But how do you decide which one is right for your specific situation? Choosing between gold and real estate is not about finding one perfect answer, but about understanding where you are in your life. This is why professional advisors often use a wealth preservation matrix to help investors decide. You have to ask yourself if you need monthly cash flow or long-term capital preservation. If you are young and looking to grow your net worth, the leverage and monthly income of real estate might be the better path. The ability to use a mortgage to buy a large asset can jumpstart your wealth in a way that gold cannot. However, this path requires a lot of work and a high tolerance for risk. As you get older and your focus shifts toward protecting what you have already built, the stability of gold becomes much more attractive. Many successful investors use a diversification ratio to balance both assets. They might own their home for the utility and the tax benefits, while keeping a liquid reserve of gold for emergencies. This balance ensures that you have both a place to live and a way to survive a total market reset. But after 50 years of competition, there is still one clear winner that stands above the rest. After 50 years of competition, the final verdict on who won the war between gold and real estate depends on how you measure success. If we look at the raw numbers adjusted for maintenance, taxes, and inflation, the winner is the asset that best survived the hidden drains of time. Real estate often shows the highest potential for growth, but it also carries the highest risk. The adjusted return winner is often the one that was never sold during a panic and never lost to a bank during a downturn. Real estate has made more millionaires, but gold has saved more families from total financial ruin. The survival factor is what truly matters when you are planning for the next half century. The surprising truth is that you do not have to choose just one. The most successful investors of the last 50 years were the ones who understood the strengths of both. They used real estate to build their wealth and gold to keep it. Your next step is to look at your own portfolio and see if you are overexposed to one side of this battle. History shows that those who hold both are the ones who stay wealthy regardless of what happens to the currency. The 50-year truth is that real estate builds wealth through leverage while gold preserves it through purity. We'll see you in the next one.